I have quite a few slides, and I think we're going to have these distributed afterwards. So there's some detail in my slides that I won't be dwelling on in my comments, but hopefully you'll find material helpful that you can refer to later. I've got quite a few slides, and we're going to try to cover this in about 30 minutes. And I'm thinking, to make sure we do that, can you click my slides? Because I'm going to use some paper with notes. You'll be able to follow it.
Okay.
And Erez, if I get to the halfway point and I haven't got to cryptocurrency, you just yell out halfway, okay? And then I'm just going to skip right to that.
I probably won't, but okay.
No, you will. We're going to touch on what we've been seeing in our continuous disclosure reviews. Then I'm going to walk through our key projects that have to do with financial reporting. You've heard about some of these before. I just want to give you a status update on those and encourage you to be watching out for those. And then in terms of the accounting issues, we're going to focus on the cryptocurrency and marijuana industry in particular. And I have some brief comments about some new lease accounting requirements coming up, as well as a brief comment on some changes relating to U.S. taxes if you have any exposure to that. So in terms of our continuous disclosure reviews, you've seen these pie charts before. We do what we call full reviews, and we do what we call issue-oriented reviews. Full reviews, we're looking at the entire continuous disclosure record of a reporting issuer, typically for the last year. And then with our issue-oriented reviews, we focus on one or more particular areas. And if you go to the next slide, you'll see what those were. Oh, actually, it's in a couple. But before we get there, here's the outcomes. So it could be as minor as you get a comment about what you could do better next time, or as serious as we issue a cease trade order and maybe make a referral to our enforcement staff. So those are the outcomes, and you can see the percentages, very similar to the outcomes categories in the last couple of years. One comment, we have in the past annually across the Canadian Securities Administrators summarized the results of our continuous disclosure reviews. We did not do that for the fiscal 2017. We've decided to do that on an aggregate basis every 2 years, largely because we're seeing really consistent recurring issues. So these are that chart was the BC results. In terms of what we are seeing for or what we focused on, here were some of the key issue-oriented reviews. The one I want to mention is the cybersecurity. We had put out a notice, and so that notice came out a while ago, January 2017, and we were looking at how disclosure in that area lined up relative to our guidance, and we'll continue to look at that area. So for financial statements, this list is pretty consistent with what we've seen in the last couple of years. A couple I want to highlight. In terms of the business combinations, we continue to see problems in terms of identifying the intangible assets, and here we typically have a disconnect between what's discussed in the MD&A and then the approach taken for the accounting. So really pay attention to that. Another recurring problem that we will continue to focus on is the approach to segment reporting. Again, sometimes seeing a disconnect between what's in an issuer's MD&A or other locations, and segments at a very aggregated level in the financial statement. So certainly asking questions about that. MD&A, these were some of the key areas we focused on. Non-GAAP measures just seems to become more and more of an issue. And we are actually doing a project on that I'll comment on in a moment. But for example, the cash cost per ounce in the marijuana sector, we've had some questions about the clarity of how that's calculated, how it is reconciled to the financial statement amounts, and so we continue to look at that, and we're actually contemplating a focused review on that particular metric over the next few months. We did this past year we did a targeted review in the ramp up for IFRS 15. That's of course now in place, so I'm not going to kind of go into details of what we were looking at there. But I did want to highlight a couple discussions that the IFRS discussion group had in October of this year relating to disclosure in the interim statements for the next few quarters. The first question that came up was whether an operating statement of financial position at Jan 1st, 2017 is required in the Q1 2018 interims, where there's been an impact from the adopting the new standard. And so the scenario that they had in mind was, well, what about where you adopt the new standard and really there is no material impact to that second year back opening? And so the response is, the way our instrument 51102 is written, there is no materiality threshold that exempts you from the requirement. However, if the issuer concluded that the effect of adopting the new standard is immaterial and didn't include that, it would be prudent to state it in the notes. The second question we talked about was, do you have to repeat the disclosure in the second and third quarter if you put the new additional disclosure in the first quarter? And so there were some mixed views about whether you could cross-reference in your second and third quarter to that additional disclosure in Q1. But we went on record of saying that we wouldn't object to cross-referencing as the regulators. The quarterly statements there on CEDAR, we think that meets the criteria for the cross-referencing approach. Our project on non-GAAP measures, we are doing a project because we've had problems over the years in terms of compliance with the guidance. And frequently, we just aren't seeing the extent of disclosures that we think users need to really understand these measures and do comparisons across time periods and across issuers. So just taking a look at the definition in our current guidance, you can see the next slide. The couple more, Grant. There we go. So current definition, kind of lengthy here, but the key point is it's not specified or defined or determined under the issuer's GAAP, and then that last phrase, and it's not presented in an issuer's financial statements. And so we've had some challenges around that. This slide here, hopefully you're familiar with it. It's just kind of a summary of what does our current guidance say. It's all very reasonable. Warn people, use appropriate name, explain why these metrics are useful, present present the most comparable GAAP measure with equal or greater prominence than the non-GAAP measure, reconcile it to the line item that's relevant in the financial statements. Don't call adjustments non-recurring or unusual if they've happened in the last couple of years, and present these metrics on a consistent basis, period over period. Or if you do determine that you need to make a change, explain what that change is and why. So recent findings, a number of problems, and a couple that I want to highlight. Prominence. This one's tough because our guidance speaks about prominence in pretty general terms. The challenge becomes how do you look at that on a metric by metric basis? And so even if a measure has been reconciled to the relevant line item from the financial statements, if it just goes on page after page focusing on the non-GAAP measures, is the overall prominence issue a problem? So we're talking about that one. In terms of reconciliations, these really, in some cases, need to improve. They're done at a too aggregated of a level, I would say, is the main problem. So we've gone through 5 iterations of the guidance, or 4 or 5, and the plan is to publish a new rule in the coming year. And the hope is that we're going to have that rule based on the principles that are in the guidance, but we want to be able to enhance our compliance efforts and give greater clarity to preparers. A big challenge is figuring out what's going to be in scope and not in scope. And we recognize that in this area of non-GAAP measures, various parties have a role to play, including industry organizations that may be able to identify and promote the use of particular measures within an industry. So, the solution to some of the challenges we see in this area are not going to all be with us as the securities regulators, but we certainly are planning to take our existing guidance and put it into form of a rule. This next slide just gives you a flavor for some of our thoughts on this area. We the Chief Accountants Committee within the CSA, we did a comment letter to the ISB, who has a proposal on performance measures, which has a lot of duplication of some of the issues. And these were some of the key messages we gave that kind of give you an idea of where we might be going with our rule. So one of the things that we said is we don't like the idea of having in the financial statements performance measures that aren't relevant to the understanding of the financial statements, or having measures that are recognized on a different basis than what's permitted under IFRS. And we don't think that it would be appropriate to permit presentation of these measures, of non-GAAP measures, adjacent to or alongside the financial statement. So that was an idea floating around there. Could you have like text boxes sort of on the same page as your financials and label those as non-GAAP measures? No, don't think that's a great plan. So that's some of our current thinking on non-GAAP measures. So hopefully we'll get to a more orderly scenario. Auditor oversight. This project has been in the works for a little while. When I talk about a component auditor in that first sub-bullet there, what are we talking about? This is where you've got a firm that's doing some of the work. They're providing audit evidence to support the signing firm's opinion, and the work that they're doing, the extent of the work by this component auditor is relating to assets or revenues that are 20% or more of the issuer's consolidated assets or revenue. So the challenge that CPAB came to us with is they've encountered challenges in getting access to inspect work done by these component auditors. So we issued a consultation paper in April of 2017, and we asked about two issues. First, registration with CPAB by these component auditors, and secondly, public disclosure about the access restrictions that CPAB encounters. We got comment letters from 6 firms, and we're deliberating the comments. Quite frankly, the comments highlight the challenges and uncertainties that were discussed in the paper. It's a very difficult area, and we understand CPAB's concerns, so we are deliberating the comments and figuring out how to move forward. So stay tuned on that one. Audit committee reporting, just wanted to let you know that we are not proceeding with a concept paper. We had gone out and asked about 2 issues, about whether investors would benefit from more disclosure about how the audit committee looks at the significant issues in the financial statements and oversees its auditors, and also asking about additional disclosure about the audit committee activities. And based on the feedback we received, we have wound down that project, so nothing further coming on that one. You may be aware of our project on reducing regulatory burden. So we went out with a consultation paper in April of 2017, and we asked about ways that we could basically reduce the burden of raising capital in public markets. The paper explored a lot of possible topics, and we got great feedback, so thank you to those in the room who sent in comment letters or participated in discussions. We've tried to narrow down the issues. These are some of the key themes that we're exploring. We're looking at taking some of the reduced requirements for venture issuers that we have and extending those to other smaller issuers, looking at our definition there. We're looking at the business acquisition reports. We had lots of commenters suggesting removing that requirement or modifying the criteria for filing a business acquisition report. In terms of prospectuses, we're looking at the issue of the number of years of financial statements in an IPO, whether that could go to the 2 years that we currently have in place for venture issuers. It's currently not 3 for non-venture issuers. The other areas in terms of comments from stakeholders, lots of comments about getting rid of overlap between the financial statements and MD&A. That's the next slide. And maybe this idea of moving to kind of the US model of having the financials, the MD&A, and the information that's in our annual information form all in one document. So we're exploring that. Feedback was support for continuing auditor review of interim financial statements in a prospectus, so we're unlikely to make a change there. And then we got some mixed views on the possibility of moving to semi-annual versus quarterly reporting. So the committee is deliberating those. We're probably going to have some comment about what areas we're going to do some project work on within the next few months. Okay, am I at my halfway? How am I doing? I'm going to talk really fast. I promise, Araz. Okay. So before we do get into some details on crypto and marijuana, a couple comments on leases. The new lease standard, and I don't have slides, so just stay here with the rainbow. It's all good vibe. So the new standard, IFRS 16, that comes into effect in 2019 for periods beginning Jan 1st, 2019. In terms of the transition, leasees will be able to use the traditional retrospective approach or modified retrospective. Leasers have to use the traditional retrospective approach. So big plug here is to start thinking of this earlier versus later. I kind of had thought, well, this standard's just about bringing leases onto the balance sheet. We all kind of know what leases are. How complicated could this be? But this is more complicated than we may have thought. And so one of the things for you to consider is some discussion held last week at the IFRS discussion group. So that's a Canadian group that talks about application issues that are coming up that preparers and auditors have encountered. We had on the agenda last week 3 issues relating to leases. Some of the things we talked about is how do you figure out whether to include a renewal period in the lease term? How do you measure the lease liability when the future payments are not known till a later date? How does a startup entity figure out its incremental borrowing rate? How do you account for lease incentives? So that just gives you a flavor. My plug here is do not leave this too late. Similar to what we did with the introduction of the new revenue standard, we're probably going to be looking for the disclosure over the next year of issuers' preparedness and what they're saying the future impact of adopting this standard is going to be. And then the last bullet here is probably relevant to only a few people in the room, but I did want to mention in the US, new legislation went into place December 22nd that relating to their various tax provisions, tax laws, and will have an impact on all kinds of accounting issues. So if you're an entity with some US tax issues, you want to be looking at this. The SEC issued a Staff Accounting Bulletin 118 a couple weeks ago. They expressed their view on the application of US GAAP requirements for accounting for income taxes for periods that include the transition time here. And that accounting bulletin has a footnote that makes a comment about using this guidance for foreign private issuers that are using IFRS. And so my comment here is that we have considered, the chief accountants from the Canadian Securities Administrators have considered this accounting bulletin. Last week at the IFRS discussion group, the chair made some comments about it, and my colleague Cameron McInnes from the Ontario Securities Commission made some comments about it. We emphasized that Canadian securities legislation requires financial statements that comply with IFRS. Of course, there's exceptions, but that's the general approach with the Canadian Generally Accepted Accounting Standards, which in the case of the publicly accountable enterprises are IFRS. And that's compliance accompanied by an audit report that expresses an unmodified opinion. Our second point was that IFRS requires reasonable estimates in the preparation of financial reports, and that extends to figuring out tax provisions. And then acknowledging that estimates may need revision as a result of new information or more experience, and those updated estimates in future periods are accounted for prospectively. And we are continuing to discuss this issue and monitor developments. So if you're an issuer with that topic, I just encourage you to keep monitoring as well. Okay, cryptocurrency, let's get into it. Today, I'm only going to talk about holdings of cryptocurrency. We're not going to talk about futures or mining or the costs of establishing a ledger. We're just going to focus on an entity that decides as part of its portfolio to maybe purchase some of this cryptocurrency, and what would some of the accounting considerations be. First question, is cryptocurrency an asset? It's tempting to skip right by this one. I think if we're talking about Bitcoin or Ethereum or Ripple, maybe it's not a big deal. You say, yeah, it is. I can buy a whole bunch of stuff with that. But there are a lot of cryptocurrencies. I think it was 1,400 the last time I looked on the list. There's some app that tells you. I'm not so sure that number 1,200 is an asset. I want to preface all my discussion here by saying there are no solid answers. I'm going to walk us through some of the considerations. This portion of my presentation reflects some of the discussion in some really good papers. There's one from the Australian Accounting Standards Board. There was another paper put together by an industry group in the States. And then last week at the IFRS discussion group, we talked about some of these issues as well. So there are no definitive conclusions. This is an evolving area. So first question, is it an asset? And then if you say, okay, yeah, it's an asset, then of course you got to figure out where are you going to look in the standards. Are you going to go to the intangible assets, maybe financial assets, inventory? Maybe you could argue, no, it doesn't fit there, and by analogy, I'm going to start looking at the approach taken for investment property. So here's the definition of an intangible asset in IAS 38. It's I've got a spelling error there. No, I don't. I'm good. Identifiable non-monetary asset without physical substance. Seems to fit, right? Now, first off, though, we want to look at the scope section in 38 because it refers to IAS 2 for inventories if we're talking about intangible assets that are held for sale in the ordinary course of business. Not so simple to figure out what's ordinary course of business for holdings in cryptocurrency, so that's an interesting concept. And then keep in mind, if you conclude, yeah, I'm supposed to be in 38, the model is that you're using a cost approach, or you can use a revaluation model if there's an active market. So maybe that's good for Bitcoin or Ethereum. And in that case, your gains are going through other comprehensive income, your losses are going through P&L. Now, an alternate view is that no, IAS 38 is not a really good fit. And one of the reasons you might conclude that is looking at the kinds of intangible assets that are cited as examples in that standard. I won't read them through them all, but you know, like things like contracts and licenses and things like that. The examples, there's not really one in that list that is closely aligned with cryptocurrency. Of course, the standard was written years ago, right? And so some people have suggested, well, even though if you just look at the definition, cryptocurrency seems to fit, this standard wasn't really developed with this kind of an asset in mind. Another argument that kind of gets you into this possible conclusion that IS 38 does not apply is this notion that what you'd really want is fair value information. That's what users want. So if we go to the framework and we look at the fundamental characteristics of financial information being relevance and faithful representation, you know, you talk to people, well, they want to know what's this stuff worth. So isn't fair value the right answer? And so then maybe you can turn to the IS1 approach that allows you to conclude that following a specific standard would result in misleading information. And so that's not going to be the right approach. So in other words, you get out of 38 through this IS1 approach. Now, I'm not saying this is appropriate. I'm just saying this is something we've heard. This is an idea being explored. So what other categories could you be in? Is it cash? Most people would say no, it's not cash. It doesn't have broad acceptance. How about another financial asset? Well, if you look at the definition, a key part of that is that you've got a contract, and there isn't a contract here. So probably not a financial asset. How about inventory? Most people would argue probably not held for sale in the ordinary course of business, maybe exceptions to that. And also the other element here in IS2 on inventories that is of interest is that there's the exception, as I mentioned earlier, it doesn't apply to inventories held by a commodity broker trader who measures the inventory at fair value, list cost to sale. So some people have said, well, that maybe you could argue that you are holding the currency in the ordinary course of business, but you get out of the general approach of accounting for inventory because really cryptocurrency is like a commodity. So this is one line of thinking that has been applied to get you to a possible fair value approach. Last sort of line of thinking is that 38 isn't applicable for some of the reasons we talked about. 2 doesn't seem to work well. And maybe we need to step back and say, well, for intangible assets, we got a problem in the standards. 38 does not distinguish between the intangibles that you hold for investment purposes versus the ones you use or you're going to consume. But when we look at our tangible capital assets and what the standards do there, we have got a distinction between the ones you hold for investment purposes and the ones that you use. And so maybe what you can do is say, by analogy, we need that distinction. And so that's the basis for arguing you should be able to get to fair value. Other people have said, well, really, this is just kind of pointing to a gap in the standards. That's probably, in my personal view, the right issue to focus on, but we know how slow standard setting is. So essentially, we got a lot of possible ways to look at this. We've got some additional comments here. This is to do with the 40 approach. And I guess one thing I'd like to say is that if you are going to take a line of thinking that gets you to fair value through profit and loss, then IFRS 13 is going to kick in terms of how to measure it. And that can be a real challenge in terms of the whether you've got an active market, whether you've got the ways to come up with fair value, the inputs you're going to need. And then another issue is the cost to sell. And so a number of factors there, which gets us to disclosure. So right now, we are looking for clarity on what the accounting policy is. Needs to be a good description of what you think you've got and how you're accounting for it. And information about the holdings and changes. I've put some of the items here. Sorry, I shouldn't say physical quantity. Like, you know, when I mean quantities is like the units, right? Units. Increases in your holdings. Maybe you're mining it, maybe you're acquiring it. How did you get it? Disposals, the change in value. And then, as I mentioned earlier, if you're into fair value, the IFRS 13 disclosure requirements, what level of the inputs are they, the active market level 1, what did you use for your primary market, which exchanges are you referring to, what are you doing in terms, like these markets never close, right? They're it's on the internet, like you can always do this. So there's valuation techniques, sensitivity analysis, and then actually that last bullet gets into the area of mining. So that's a whole other topic. Maybe we'll be talking about that one next year. So I'm going to close with marijuana. And well, we're going to just very briefly refer you to these two notices on here. I'm not going to talk about those, but a big change that happened. We put out a notice in October talking about the disclosure you have to put out there in view of the uncertainties about activities in the U.S. And last week we put out a statement because in the U.S. a key document known as the Cole Memorandum that explained how the approach to enforcing federal legislation was or was not taken has been rescinded. And so what we have said as of last week is that we are re-examining our views because of this development, and we are considering whether our disclosure-based approach for issuers with activities in the U.S. market remains appropriate. Issuers that are not in the States in any way, this is not the focus of our current reconsideration, and we're going to communicate our position shortly. So here's a little chart on cannabis growth cycle, and you can see the stages, and during that first stage, the relevant standard in IFRS is IS 41, agriculture, and then once you get to the point of plucking those leaves and harvesting, you're moving over into IS2, inventory. And the key distinction here is when you're within 41, you are recognizing changes in fair value as you go along. So if you've never done agricultural accounting before, this is pretty novel. It's complicated. This is a very simplistic overview. And so you might want to dig into that. The biological assets, initially at fair value through fair value less cost to sell, subsequent measures on that basis, and then on harvest, you're transferring at that fair value, that becomes your cost as you move into inventory. Interestingly, the topic of production costs is not spelled out in 41, and so we are looking for clear disclosure of whether those costs are being expensed or capitalized. Once an issuer has been producing for a number of periods, this is not a big deal, but in those startup years, this is going to have a big impact, and it will affect the changes that are coming through in terms of the changes to fair value. The reconciliation is the key piece of disclosure. So that opening balance plus your additions, your changes in fair value, what you're transferring into inventory down to your ending balance. And then this next slide lists some of the other items of disclosure. The And then the one that I'm missing from here, we already heard highlighted earlier, which is disclosure around the estimates, all kinds of estimation stuff. And then, hit it again. This is Anita. No, keep going. Yeah, if you hit it again. See, look at that. This is what my assistant put in here. Anita is here. I have to thank her for putting together my slides in this area. So we've been spending a lot of time on the non-GAAP measures. And when you get into the cash cost per ounce, this is a challenging area. I think we've seen some really good disclosure, and if you flip forward, you'll see the next two slides. When you get a copy of these, you can look at that if you're interested. A pretty reasonable example of disclosure. The red items are sort of highlighted because they correspond to our guidance on non-GAAP measures, but I think we've got a bit of a learning curve in terms of understanding this metric, how it relates to the line items in the financial statements, how it varies across the industry players or not. So we're doing a bit of a targeted review here, and I think next year I'm probably going to be commenting on this area. So I'm sure I'm over my time. I'm even afraid to look at a res at this point. I'm just going to sit down. I'm good? Okay. And we'll be taking some questions. Yeah, my last two slides there were stuff not really specific to marijuana industry, more about if you've got some restructuring going on, to just be aware of whether a target entity is going to be viewed as an issuer, and also the goodwill and intangibles issue that always comes up with these kind of restructuring transactions. Okay, thank you.